we were absolutely nowhere because nothing happened. Okay, hey, this is the wrong screen for the webinar. That seems to be the problem. All right. How bad would it be if I try to change all this stuff? Let me think. Other bookmarks. I don't have a webinar. Damn it, because the webinar is under Jackie's login. It's not under my login. All right. Well, we'll just have to put it up one at a time, I suppose. Let's see. What's going to be the most likely thing to look at? The right Dell, I think, right? Yeah, okay, let's start with that. Open the right Dell. And this can be Phil Stockworld, although Trump plans to give State of the Union next week in the House. I wonder how he's going to do that. Disregarding Speaker Nancy Pelosi, can he do that? I wonder. That's interesting. Imagine if he just came to your house and started making speeches without being invited. All right, blah, 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 blah. Okay, great. So let's see what happens. So here's our thing for today. Here's stock charts. That's always useful, except IBM. Let's see how IBM is doing. Very nice. Okay. Here's Yahoo. That's useful. Oil futures are useful. All futures are useful. Okay, we got a nasty little turn down there from the 10 o'clock, which we decided was because of the, I don't know, one of those Fed reports. I don't remember which Fed report. Well, let's find out. If you want to find out what's happening, check Phil Stockworld. Let's see. When did we make a note of that? That's about 11:30. Richmond Fed, yeah. So the Richmond Fed was negative, but you know, it was way better than last time. So I guess they expected a huge turnaround, but it wasn't that bad. So I didn't think that was a good reason to go down. It didn't make me more bearish. And then we had a couple other things. We got the bank. All right, well, let me look. Here's the news. If the market goes down, look at the news and say, why is it going down? Well, the Richmond Fed said this, and it wasn't Papa John's fault. It's not the Bank of Japan's fault for continuing stimulus. Who cares what Seritage is doing? Chevron, who cares? Boeing, who cares? UTX, RBC warns on Tesla, not a big deal. P&G, good. Morgan Stanley likes Walmart, so that's generally something good for the market. Qualcomm is bad because Qualcomm is, you know, probably going to stop, people are going to stop them from trolling everybody with patents. Comcast is good. So none of this is really negative that I would be changing my stance on. Then we got over here and we picked a stock because there's opportunities. Then I was here. People are worried about global growth. By the way, you always got to check Davos because Davos is on and who knows what people are saying over there. Somebody's saying here's risks of GE and other stocks that helped us go down lower here. This was a big one because William Blair's guy said negative things about the industrials. But the Chevron CEO said he thinks things look okay. You know, he's over at Davos too. FedEx and UPS brought down the transports because of this Amazon stuff that's going on. But nothing major changing, so there's no reason not to do it. So I made a call for going long on the Russell at 1450. This we still there? Well, we could do that right now. Wait, let's see. Nope, I thought we were higher. So 1450 was a long line yesterday that worked out well. We went over 1460, so we made at least $500 on that, and hopefully we can make another $500 today. But keep in mind though, if we have trouble at 250 at 1450, 250, no, sorry, 250 would be at 1455. If we hit 1455 and run into trouble, then what you have is a declining line with weaker bounces each time, and that would mean that's not very bullish at all. So if we don't clear 1455 and move on to 1460, then this whole thing suddenly turns a bit ugly. So we'll see what happens, okay? And I don't know what kind of good news we'd be expecting this late in the day, but we'll see what happens. So we like that. We were talking about Amazon and FedEx and UPS over here. That was the most recent thing before the webinar. So the big trade today was on a Signet, the jeweler, and you know, look, the problem jewelers are having is there's a couple of problems. First of all, gold is all over the place, and you know, people aren't really, the millennials aren't really as into jewelry and stuff as the older people were, and the whatever the hell the new people are called. Are they millennials? I don't know what they're called anymore. But whatever all these kids are called, my kids, and I think my kids are millennials. They are not big jewelry people. It's not important to them, and that's hurting the industry. The wedding, even the wedding ring thing is going out the window. The engagement rings and such, it's not as people don't want to spend that kind of money anymore. And artificial diamonds are diamonds. The diamond industry is pushing to make sure it's called artificial diamonds, and to try to say you can't call it a diamond if it wasn't pulled out of the earth by some African slave. It's really insane. But the reality is that the only difference between an artificial diamond and a commercial and a mine diamond is that an artificial diamond is perfect. It's subjected to heat and temperature and pressure until it forms a diamond. This is how you make a diamond. This is how the earth makes a diamond. Heat and pressure and temperature. Well, heat and pressure, sorry. Pressure and temperature over time makes a diamond. Pressure and temperature over time makes a diamond in the lab. It's the same diamond. You know, I can't think of a good example because it's not like there's a naturally occurring pair of Levi's, but you know, in theory, if there were Levi's growing on in cotton fields, and there were Levi's that somebody made in the factory, they'd be the same freaking thing, basically. You know, if they were Levi worms or something like that. It's not artificial. They've actually made it because it's not. It's hard to make artificial food or artificial bacteria, things like that, because they're complex organisms. A diamond is not a complex organism. A diamond is a compound. It's an organization of a carbon chain. So it just is difficult to create, but it can be created. And if you created it, it's a diamond. So the bottom line is, though, that these companies are now manufacturing perfect diamonds. And they're hitting the market, and people and most people don't care. I made a note when I was talking about it, I said my mother and I, oddly enough, just had this conversation 2 nights ago, because we went out to we were in West Palm Beach, and there was a lot of jewelry stores and stuff, and in West Palm Beach they leave the stuff in the window at night. They don't pull it in. So we were walking past these jewelry stores, looking at the stuff. And they had a lot of, artificial diamonds. And in one of the stores, not most of them didn't. And one of the stores had artificial diamonds. And my mother was like, I'd be so mad if somebody gave me one of those. And I'm like, why would you be mad if someone gave you an artificial diamond? Who cares? But she thinks that matters. Like it somehow cheapens the effect. And but once that generation goes, I could care less. And I think my kids couldn't possibly care less. So they've got a long-term problem with the prices of their biggest markup product. And that's the thing, by the way. Gold is a commodity. Gold is sold for the price of gold, and jewelry stores don't get away with a lot of margin on gold. The way they make their money is the gems. And those the gems, they make tremendous amounts of markups on. You don't, the grading and all, unless you're a really good shopper, you get basically screwed when you go and buy a diamond. And that's where they make all their money. All the people who come in there and buy a wedding ring, and they make 50, 60%, 100% markups. So anyway, so that's a bad thing about the business. But still, nonetheless, they're down from 65 down to 24, which is a little bit of an overreaction, especially when you look at the numbers where they made 5 billion, 6 billion, 6 billion, 6 billion, 6 billion. Next year they'll make 6 billion, and next year, the year after that, they'll make 6 billion. So they're going to keep making 6 billion. Their margins are declining, so that's bad. It looks like their margins. I don't think they'll stay this low. I think they're reorganizing a bit. Because look, when they made $4 billion, they made $350 million. They're not that pathetic as business people. So, $200 million, and I forgot the number, but oh, come on, really? Yahoo, no, finance Yahoo, not a chart. Can we just, there we go. So they're $1.2 billion. So even if they were making $600 million, that's what I was saying. So it's kind of ridiculous, because as I was looking it up, which thanks to Wilson's pointing it out, but as I was looking it up, what did I just do with here? Okay. So as I was looking this up, I'm like, okay, so you can buy the whole company for $1.2 billion, and they're going to drop $200 million to the bottom line, which is 1/6. So they're only trading 6 times really low estimated earnings. That's a little extreme. So I think there's definitely room to run. And I made a note, and I said I came up with a price. I think 28 is probably a fair price for them. But nonetheless, I'm very down on the sector. I'm very down on the concept. I want to see how they turn it around. So if I was going to do a full trade, which is this is an answer to Wilson, so he was saying I want to do a trade on this thing. If you want to be aggressive, you can do that right now. But I said, you know what? Why don't we just sell the 2021-20 puts for $550, because that nets you in for $14.50, which is way below where we are now. We're at 24 now. So you got another $10 to go, which is like 40% of the price. So they could drop another 40% and we're still even. And meanwhile, you're picking up a lot of money. You're picking up $2,250 in exchange for promising to buy $10,000 worth of stock. That's 22% on your worst case scenario. And of course, your worst case scenario is really $7,750, because your worst case scenario includes you've got the $2,250 in your pocket. So your worst case scenario is you end up with $7,750 worth of stock and at 500 shares. So you're paying, I don't know. I used to be able to do all this stuff in my head without even thinking about it. Bad. All right. So 7,750 divided by 500, 1,550. All right, so 50. So your worst case scenario is you own them 1,550 a share selling the puts. And otherwise, though, you're going to get back 2,250 divided by your maximum risk of 7,750 is 29% in 2 years. What's wrong with that? And what better do you have to do with your money? Think about it. It's like if you have money sitting around doing nothing, here's how you can get 1% a month on your money. That's the kind of stuff you should be looking for in your portfolio. It's like you don't have to take the risky part of the trade. You don't have to sit there and say, I think it's going to go to $28. We can wait and see on that. But if you think this is a good deal now, step one, and I'm going to emphasize that this month, I am very much emphasizing our process in portfolio selection. Step one is sell the puts. Give yourself a huge discount. That's the first step towards buying a stock. Say, okay, I like the fact that Signet is down to $24, but you know what? I'm not excited. I just think it's kind of a good opportunity here, but I would be excited if I could get into the thing for $14.50. At $14.50, it gets kind of exciting, right? Then I'm like, wow, that's damn cheap. $10 more down from here, and that thing becomes something where I would say, you know what, I really feel kind of compelled to take it. So meanwhile, I'm being offered $2,250 to take that risk now. Now, of course, if the stock drops further, then you can be down 100% very easily on this trade. But the question is, then did you really want to buy it for net $14.50 so you can stick it out, or because the stock only has to go down to 20 and you'll be down 100% on this trade. So did you really want to buy it for $14.50? And if you didn't, then maybe you don't even want to buy the stock. You got to really want a stock if you're going to sell the puts. Don't pretend you want it. Don't say, I'm really selling the puts to offset the price. Because that's how you get screwed, because you didn't really want the stock. Then when it goes against you, you're like, oh my God, why am I even in this thing? Blah, blah, blah. You have to be willing to put your foot down. And I think the liquidating value of Signet at 14 is probably compelling. I think somebody would probably come up with under $1 billion to buy them out. It's a big company. They got a huge footprint. Even if you turn them into something else, even if you come up with other concepts besides just trying to sell expensive jewelry, so you can. There's a lot of things you can do with it. So it's a matter of, when you have $6 billion worth of business, there's a lot of ways you can figure out how to sell another 20% of something. Anybody in retail is one of the things that as a consultant, when I talk to my retailers, I'm always saying, I'm like, okay, you're kind of dead-ended where you are. Like you're selling office supplies in a city and there's only so many offices and you've got so much percent of the office supply business. So, of course you want to try to maximize your percentage, but that's what you've been doing, right? That's what you do for a living. You try to maximize your percentage of office supply sales. That's kind of hitting the loggerhead. That's why I'm consulting usually, because there's a problem. And I said, well, how about consider not selling office supplies? How about look at something else you could sell to the people who are buying office supplies? And that's what, same kind of concept for Signet. So, I think when I'm evaluating a company, I think ahead of like, well, what else could they do? Could they put other stuff in their stores? And sure they can. You see these jewelers doing it all the time now. They put in crystals. They put in, the Swarovski things, or they put in little figurines. They put in other knickknacks that are, things that are sparkly and nice and valuable also that people like to buy. So it's not just a bunch of jewelry where kids walk by and say, I don't want any of that. They put cool stuff in the window that's interesting, and people say, well, I want a little, I don't want to pay $1,000 for a ring, but I'll pay $500 for a little figurine that, that has a way better markup than the ring does. All right, so there's ways to fix it that I could see ahead, which makes me kind of think like there's a good bottom to something. I'm always looking at that. When I think about a business, I say, is there a way to fix it? With Disney, for example, when I look at Disney, I'm like, okay, they got this, they got that. When they have the ESPN problem, we bought a lot of Disney. Because I'm like, okay, well, first of all, they can just get rid of it. It was draining cash. So I'm like, well, they could get rid of it. It's not core to their business. I mean, they don't want to, obviously, but I mean, if they had to, they could have gotten rid of it. But they had a problem with subscriptions. They had to figure that out. They could have gone to more of an advertising model. They also could have just ditched it and concentrated on something else. And Disney has tons of cash, tons of customers, tons of revenue. They could have done 100 different things to improve their business, but they actually fixed ESPN and sort of stopped the bleeding and turned it around a bit. But that was possible too. But that's why I loved them at the price when they were selling down below 100. I was like, that's just stupid. They could, and also another thing Disney can do is stop spending money. They spend unbelievable amounts of money. They spend money making movies, which has been very successful so far. They spend money making more theme parks, so they could cut that back anytime and drop a couple of billion to the bottom line. They spend money on new rides. There's a lot of ways Disney can tighten their belts anytime they want to. So, when you look at a company and you say, well, they're not really in trouble, and people are treating them like they're in trouble, that's the time to get into something and buy it. So with Signet, I think they're in trouble. They're certainly not the company they were. And I think the initial thing that Wilson said was something about picking up 28 calls or some such. I don't remember exactly. Oh, here it is. January 2020 covered call play at 4 with a $20 put at 360. So I gave him something very similar. I said, I was doing something similar. Oh, I went further out in time. Look, to me, if I'm going to sell a 2020 put for 360, but I could get 550 for a 2021 put, if they go to zero, I get the same I get 550 instead of 360. I'd rather have the 550 right now so I have a little bit more cushion. So that's my logic there. All right, let's see if we got any questions on anything going on so far. Tom says, I hope they don't figure out how to make artificial gold. They absolutely will. They absolutely will. They are getting so close to being able to nudge more. Well, okay, first of all, I'm sorry. They can make artificial gold right now. And again, it's not artificial, it's freaking gold. Okay, you move a molecule around, it is no longer whatever it was. It's it's no longer lead, it's now gold. It's alchemy, right? They use lead. You have to be able to use something that's less valuable than gold, otherwise what's the point, right? So that's why everybody is always looking at lead, and it's got a similar atomic weight. That's important. You have to have the right amount of atoms, and you can add and subtract a few atoms or electrons, and that's how you turn one thing into another. So the question is, how do we do it efficiently enough to make a quantity of gold? They can make a little bit of gold. They absolutely can do that right now. They can make a little bit of gold, but it's not cheaper than digging it up. But one day, there'll be a breakthrough, and they'll say, "Oh, look at that! Now we can make a pound of gold for the cost of a pound of silver." And then you screw that. Well, I mean, I don't think it's a bad thing. It's just going to mean everything's going to be look cool. We're all going to look like Donald Trump's house if that happens, right? Everything will be gold plated. That'll be fantastic for electronics. If that happened, I would go all in on electronics, because the advances we would make in electronics, if we could cheaply put gold on everything, it would increase increase the efficiency of circuit boards and things by incredible amounts. Gold is an incredibly great conductor and would be superior in so many different ways that we could use it. So if it was cheap enough, then yeah, of course. But yeah, it's weird. They'll be able to do everything. They will be able to print. It'll look like Star Trek. There'll be a thing. Not now. I mean, hundreds of years from now, it's going to take forever to make it, to make all the advances. But there will be a thing. I forgot what they called it. Replicator. They called it a replicator. There'll be a thing that essentially atom by atom 3D prints whatever you need, and we'll just basically place. It'll use a stock of raw material, which will be something made. They'll take atoms and electrons from something and make whatever you want out of it. And they'll just start assembling molecules and assembling atoms bit by bit, and it'll be done. And the thing you need is an incredibly powerful computer. So that's what we're pretty much there with the power of computing. Then you need a method of assembly. But if you have a computer that can hold the entire makeup of an object and shape of an object in its head, then if all you need then is a printing arm, right? And once you figure out the printing arm, you can make anything. So it'll be interesting, but long time from now. But of course, if we're lucky, they'll be able to make hearts and lungs and brains and things like that when we need it, because that is on the horizon in the next 20 to 40 years, I'd say. So you'll be able to start replacing all your bits, and then we'll last a lot longer. So who knows how long we'll live if that happens. And of course, providing the planet survives, but don't get me started on that. Okay, Greg says, I'm here. Greg didn't recognize my number. I called him from my Florida home number. Put up a note on PSW. Okay, good. All right, so now we're all caught up on questions, which are not too many, really. And we're caught up there. And I think what I'd like to do, let's see how the market's doing. It's recovering a bit. Oh, and see what we were just talking about. So look, I mean, it's almost a reflex. Look at when I made this call to go long at 1450, which we're only fading at right now, so it's not a big deal. Everybody was hitting these green lines. So if everybody's hitting the green lines, then probably we're going to bounce off the green lines. It's not complicated. It's like, look, everybody's hitting the support line at the same time. So, let's see who's bouncing. So it turned out that the S&P was a better call for a bounce than this guy was, but he's okay. And the dollar, where's the dollar? The dollar tanked. So things would look worse if the dollar hadn't tanked. Natural gas took a bit of a dive, but it's recovering quickly, so I don't know what that was about. Gasoline went way down, but we like it down here. I would have loved it if I saw that. I didn't see that. I guess I don't know what I was doing then. I wish I saw that, because that's fantastic. And And Brent, of course, bounces off 60. I didn't even make 60. We bounced off 52. So, that's how you call it. You gotta know where your supports are, but that's obvious. And we hit this one yesterday, and it did very well for us. So we'll see if we get there today. But I also warned if we don't get I was saying, look, we're in a downtrend. But I think I just said that to you guys. And maybe you didn't hear me though. We're in a downtrend. And yesterday we got a bounce, and the bounce went up more than 10 points. Now, so if this bounce goes up less than 5 points and we come back down to the line, that's dangerous. That means it's fairly bearish motion. We're probably going down. This guy's just kind of consolidating though, so hopefully it's going to consolidate along this line and eventually pop back up. But we're totally rumor driven right now. So based on whatever the last person in Davos happens to say, the market goes up and down like crazy. It's really insane. Ricketts. What is a Ricketts? Cancel. Ricketts.ba. I wonder what on earth I was ever looking at Ricketts. I don't even know what that is. Must have been something I was linking to. What was I saying? Oh, it's the Phil Stock World again. So go back to Phil Stock World, and we'll take a look at our portfolios since we just did the review. And what I've been emphasizing this month, because I think it's really important, is it's how we do things. So you know what? Let me reclassify this because it needs to be reclassified. Jeez, it's long. When they're this long, I'm scared to edit them because I always think like it's going to break the brain capacity of the computer. I never know why obviously sometimes it crashes and you figure it's overrunning the memory somewhere. But I think this thing can handle it. Because right now it's not in the portfolio review section, so I'm going to change that. Portfolio review, and also it should be members only. There we go. Only members can see it anyway because it's a 2-day rule. You guys know that, right? Like only members can see stuff for the first 2 days. So even if you think it's a free article, it's still other people can't see it. All right, so anyway. All right, so now if you go to the virtual portfolio tab, you'll see that now we got the review where it belongs. Okay. I'm sorry, it's boring. I don't know if it's boring, but I use that every time because I love it. It's one of my favorite things. So I only start using it when we get to $1 million, but we got to $1 million a while ago this year. The STP, LTP combined. Now we're insane amounts of money. We had such a good play during the downturn because we got much more bearish here, and then we got extremely bullish here, and you can't ask for better. I mean, you can't possibly do better than that in the market. And the key is, look, the key, we play with hedges, and we expect. Let me make this bigger. You expect up, down, up, down, up, down, up, down. That's normal. We always have some hedges, and just in case, and whatever. And again, I say, generally, I want to be hedged not for a 5% correction, because that's a waste of money. Okay, that's like bubble wrapping your kids because they might scrape their knee. Okay, it's overkill. If they get on a bike, then you want to put on some knee pads and a helmet. But if they're not on a bike, they're just running around. You don't put on knee pads and a helmet. They look like idiots. And what's the big deal if they get a couple of dings once in a while? Life goes on, right? So it's the same thing with your portfolio. You can't hedge against everything that could ever happen. Your portfolio will go up and it will go down. In fact, it should go up and down because you should have some sort of bias. If you hedge yourself to death and have no bias, what are you doing? All you're doing is making your broker rich. Because you can't make money going up and you can't make money going down after a while. You have no bias. You're neutral. That's not, if you're going to be neutral, why play? Do something else. Get a job. It's not. Why be? You're not a trader if you're not willing to accept some risk. You want to mitigate it. And what we do is we try to mitigate the damage of a 10% correction so that it only hits us like a 5% correction. We want to mitigate the damage of a 20% correction so it only hits us like a 10% correction. And generally, we hedge to 20%. So in other words, we'll pick hedges that kick in around 10%. In other words, if it's a 5% correction, the hedges practically don't do crap. And people get very upset because we have a little correction and people go, oh, no, the hedges didn't work. I'm like, they're not supposed to work. They're not there for that. But when we have a 10% correction, the hedges kick in and they offset about half of it. And that's fine. Because if you start out with 100% and the market goes down 10%, right? But your hedges protect you from half of that loss, then you have 95% while the market is now priced at 90%. You've actually gained, even though you have less money, you gain buying power. But that doesn't do you any good at all if you don't exercise it. And I think people don't understand this. I've been contemplating why is it that I have people who've been with me for years and we still have the same old, discussions about certain things. And I think this is something, that's why I started to emphasize this a little more. The way we structure our system by first selling a put is my favorite way to get in something. You sell a put first. Then if the stock gets cheaper, buy a bull call spread, add to it, assuming, of course, that your premise doesn't change. And we start out small and we get bigger and bigger if the stock goes lower for us. So in other words, like here, I would have sold an S&P put for maybe a 10% decline. So here's 27. So let's say down around 25, I would have sold it. So let's say I would have sold a 25, if it was a stock, I would have sold a 2,500 put here. And I probably would have picked up 10%. Okay, that's typically the way it goes. So the S&P goes up, my put does nothing, goes down, my put goes up and down in price, whatever, but it never really falls below the line where we started. So no big deal, no big deal, no big deal. Now, meanwhile, we're out to October. So if I sold 2 years at 10% and the stock is higher and it's October now, almost a year is gone, I probably made about half my money by this point. I probably made about 5% back on put I sold by that time. And honestly, if that's all I do all year long, that's fine because 5% is a good return on your money. It's better than you can do in bonds or anything else. So as a straight out bet with my unused cash in my portfolio, I sell a put, I'm handed more cash, and then I wait. And if it gets cheaper, I buy it. If it never gets cheaper, I keep the cash and I make 5% a year over 2 years. My worst case scenario is I make 5% on that money. But in this case, we got a nice drop. Our line, don't forget, is 25, so we're certainly not panicking that it goes a bit below, right? Don't forget we sold the 2,500 put for 10%, so we're at 2250 is about our break even on this thing. So when it goes down here and it's 2250, I go, oh, now I want to buy a bull call spread, right? Now it got cheaper. I have this tiny little commitment here. Now I've got a 20% correction. Fundamentally, I thought it would hold up. I thought we were overcorrecting at that point. And then is the time to buy a bull call spread. This is our system for everything that we do. So then we pick up a bull call spread. We're able to pick up let's say we got the 23.25 or 23.26 bull call spread, and we get it for about half of that price. All right, we're already on track to make 100%. So all of a sudden, that little 5% annoying trade that you don't think is worth doing, because it alerts us when it goes down, and we look at the trade, and we've been watching it closely all year. By the way, one of the reasons also I like to sell the puts is it's a watch list for me. It makes me pay attention to that stock. It forces me every month when I review my positions, at least obviously, but every month when I review my positions, I contemplate that stock. and where it is and how it's going and whether I want to keep it and if anything changed. That's what I do every time I do these reviews. You have no idea how long it takes me to do these reviews. I analyze every stock as if it's like the first time I'm looking at it. We're going, so when I have a put, it forces me to reanalyze every single month at least and look over everything again. So when something does happen like this, I know off the top of my head, oh shit, look at the S&P, that's a buy. I don't have to think about that. And in this case, the way we got bullish on not the S&P, the way we got bullish is on the Qs and on the on TZA and on the Russell. We deconstructed our hedges, which left us with the short calls on the ultra short positions like SQQQ and TZA, and that made us extremely bullish at the bottom. All right, and had it gone the other way, we would have had to quickly regroup and deal with it, but we had a good line. I basically, down here on December 26th it was, I remember because it was right after Christmas, it was December 26th, I was like, holy shit, is this a great opportunity? Because we had gone down on ridiculously low volume. We had this huge crash on low volume, and it was mostly over the government shutdown, which is stupid, because it's something we did to ourselves, and all you have to do is open the government, and the shutdown's over. And the China trade bullshit is another thing. But, honestly, if we didn't trade with China and China didn't trade with us at all, the world would survive. We would just trade with other people, and China would trade with other people, and that would be that. It would be stupid, it would be inefficient, but not 20% of the economy inefficient. It would probably hurt both of our GDPs, but our GDP is $20 trillion. Our trade imbalance with China is $500 billion. Do the math. And that's an imbalance for us. So again, not trading with China isn't terrible for us because we only export 300 billion to them, and we import 800 billion. So we import 800 billion from someone else. It's not like we're going to stop buying stuff. Maybe only buy a little more American stuff, who knows? But either way, it's not going to affect our economy. The 300 billion in sales to China, who cares? Who freaking cares? Whether we say with $20 trillion economy, $300 billion of exports to China, what are you freaking talking about? How is that even a thing? So, that was my logic in saying this is stupid. 20% is too much of a correction. All right. Now, I don't expect us to go back to our highs. In fact, we actually are. We are at now the correct spot. This is where we probably will settle out. Because given what's going on, even without a government shutdown, even with a trade deal with China, we shouldn't get back to these highs. These highs were too high, even if everything was going perfectly. As I said all summer long, okay, in July, I cashed out my kids' college accounts here. And I still haven't put them back, which I regret, unfortunately. It's just, I was just not, I should have done it. I'm sitting there making all these moves here, and it didn't occur to me to put the kids' college funds back into the market. So they're still in cash, and we went up so fast that I never got it. So I'm still in cash. But fortunately, they have enough money to pay off their college. They paid plenty of money for college now. And that was why I cashed out. Because again, I cashed out my kids' college funds. They're both about $250,000, I guess. That's about how much is in each one. So that's easily going to pay for 4 years of school. So what's my risk reward here? I could leave the money in and hope the market goes higher, but they don't need that money. But on the other hand, if the market goes lower, like it did, and it wipes out 20% of the money, then I would have lost $50,000 or basically a semester of school, even if there was no leverage in the account. So where's the logic in risking, not a semester, a year? So where's the logic in risking a year of college against a gain I don't need? Makes no sense. I have to look at it from the perspective of what the fund is there for. The fund is there to fund their college. The fund funds their college. If I leave it in cash, they will absolutely have their college funded. It makes no sense whatsoever to risk that money. And you have to look at your whole portfolio like that also. Think of your accounts and what you're trying to do with it, what you're trying to accomplish, and what you're risking. Do not risk 5 years of your retirement in order to get 5 more years when you'll be dead. Okay, it's not worth it. If you have 20 years worth of money and you're 60, 70 years old, and you're, what are you going to do? I understand that obviously you want to try to make money, but there's no reason to take a big risk. Don't go crazy. Every year, try to make enough and try to make 5%. If you have 20 years worth of money to retire, try to make 5% this year, because if you make 5%, you still have 20 years left next year, and you could live forever doing that. And how do you make 5%? Sell the freaking puts. Don't take a risk. Just sell the puts. You don't have to do anything else. You don't have to be aggressive. You don't have to go after freaky stocks. You don't have to chase momentum trades. If you don't need to take a risk, don't take a risk. You got to be realistic about where you are in life, okay? If that's your only source of income, then you need to protect it. That's more important than playing it. I probably will never quit, but I mean, let's say I got 10 years at least left. I'm 55 now, I'll be at least 65, I'll still be making money. So in 10 years, I'll make more than 10 years worth of retirement money. So I can afford to gamble because I'll just make more money. It's not a big deal. If I lose it, I'll make more. It's okay. You have to think about where you are in life, where your goals are. You always need to have a financial plan, and that's for everything. Even like I said, even a little college fund. And that, by the way, is influenced also by the fact that when it's non-taxable as it goes up, but then if they're left over with any money at the end, it gets taxed 50%. So it's not even worth trying to make more money. It's like once you hit your goal, it's like, what's the point? Just so I can give money to the government? So unless Maddie is probably going to go to grad school. Jackie's not going to go to grad school because if she sticks with it right, she plans on being a programmer. So if she's a programmer, there's no grad school for that. You just get a job and program. But Madeline wants to be a psychiatrist, so she's almost likely to go to grad school. So she'll use up her whole college fund, but Jackie won't. It'll just sit there. And if she makes more money, she gives half of it back to the government. So it's not really worth it. Anyway, so purpose-driven investing. Everything, whenever you're investing anything, you think of why am I investing it? What am I doing? What are the risks? So on and so forth. So, like I said, with this kind of thing, if we have our put here and it gets down to close to what our net price is on the put, we have to say, first of all, we better really want the S&P, but if we don't really want to own it, then we look at, can we roll it? Can we do this? Can we do that? Fine, if we didn't like it. Or we could take the loss, because the loss, again, we take a very, very small allocation at the beginning, so the loss is very insignificant to our portfolio, even if it is 100% loss. Because it's 100% of a tiny amount. We always allocate a very small amount to the first round, and then we see what happens. But in this case, we decide we're going to stick with it. We buy the bull spread that's going to make 100%, and now what happened? We have this initial thing where we're going to make 5% a year, but then we do get a downturn. It does flash a signal to us that has us buy into it. We basically double down as far as the cash into the trade. But now we end up making 110% as long as it stays over 2,600. But 26 is where we started. So all the S&P had to do is stay flat, gyrating meanwhile, but all it has to do is essentially stay flat for 2 years, and we make 110%. And that's obviously not going to happen on every trade, although frankly it's happened to our whole portfolio this year, but it's not going to happen on every trade. But that's the point of selling a bunch of puts. Oh, that's what I didn't do. I don't have power options. Oh no, I got that thing. We got the review. You can see here. So page down. Well, that's not the long-term portfolio. We have the long-term portfolio. That's not it. Oh, that's it. You can tell by the short puts. Okay, so And I'm sorry, this is not big. I can't, I guess I can control plus it. Oh, yeah, that's pretty good. Okay, look at that. So what do we do in the long-term portfolio? We sell puts. There's 2, 4, 6, 8, 10, 12, 14, 16, 18, 21. There's 21 short puts here. Every month, which is pretty consistent. I'm sorry, it's not every month because this is only in 1 year. So in 1 year, and by the way, we bought some back already. We've already cashed in some. And in fact, we cashed in another one. I think we cashed in, did we cash in FNSR? I don't know. We cashed in one of the ones that was up 60%. We cashed in. Broadcom, maybe, I don't know. Now that was too silly to cash in. We'll see below. But anyway, we've cashed in plenty of the short puts that have gone up too fast. And we say, okay, you know what? When you make in your first year, when you're up more than 60%, you may as well take it off the table. You can always sell another one that's going to make 100% instead. Why keep the one you've got when it's only going to make less than 40% the next year? Think about that. You have a 2-year sale window. In the first year, it goes up 60%. That means in the next next more than a year, it's only going to make 40%. Whereas if you sold a brand new one, it would make 100%. It's the same concept, the same if everything goes well. Obviously, if everything doesn't go well, then the one you're holding on to wouldn't work either, right? So the smarter thing to do is cash out, take the money, and look for something else that's a better bargain than the one that you just had. We do this all the time. It's a very subtle thing that we do. But in other words, every month we sell a couple of puts. And those puts generally raise $5,000 or $10,000 in the long-term portfolio, which is started out as a $500,000 portfolio. We generally like to, as an initial position, collect about $5,000. Now the portfolio is now $1 million, now doubled. So we're a little bit, sometimes a little bit more on them, certain positions where we want to get more. But we generally start out with a small amount, but we look to collect about the things we can make $5,000 on. So here you see we collected, forget Apple, because that's an exception, obviously, but we collected 2,700, 9,300, 4,200, 2,500, 5,000, 5,000, 6,000, 5,000, 97, 11,000, 6,000, 6,000, you know, like that. So we've collected here well over $100,000. Forget Apple. With Apple, it's over $150,000. So we put $150,000 into the portfolio in cash. We've obligated ourselves to these positions. Okay, but the margin is less than the cash we collect. We generally don't do things that are margin inefficient, so we usually collect at least as much cash as the margin charge is going to be. So if you have a portfolio margin account, that will generally give you more margin than you started with, you know, or not significantly less margin than you started with by having these positions. So we collect the cash. I mean, well, it impacts the margin obviously by the amount that you have the margin net, but very, very, very small impacts to these things when we do them. And then we sell calls that offset that. So then, you know, it depends on what happens. But the point is, if we have $100,000 of short puts each year that we're selling in a $500,000 portfolio, that's 20% of the portfolio. They're not all going to be successful. We're not going to make an automatic 20% on that, but that's just the way we start our trades. We initiate our trades with a potential 20% gain just selling short puts that roll over. See, now what happens is if the whole market collapses, that's what we have a hedge for. If the whole market collapses, we could go very negative on these things. All these things could turn red on us. Look at Apple's $20,000 red right now. So if things turn very ugly, that's a problem. But generally, in a flat to up market, we're going to collect $100,000. We're going to collect 10% a year, at least, if the market does nothing, and if all of our other trades do nothing, or if we don't even make any other trades. But then the trades we do add are being added at significantly lower prices. I'm not even interested in adding to a trade until I see red here. And when I see a big red number and I see C's down 34%, I say, ooh, what's going on there? That makes me want to look at it. We sold the 42 puts for 450. They're at 38. That's our target. We net in at 37.50 here. And they're at 38. This is the bottom. This is what I thought the bottom would be on them. So I'm not worried about the $775 loss. I'm not worried about being assigned $20,000 worth of SEE. I want to know what's going on with those guys. Is this now a good bargain? Is this something we want to take a bigger position in? What? Wait a minute. $38. Oh, I had 28 in my head. Okay. I'm like, what happened to the price? All right, so where are these? The 38. So we came in at 42, which was up here. Oh, I see. This is a short-term chart. That's what's wrong with it. So we came in at around 42, whatever that was. And we sold puts, so probably it was higher, and we sold puts. And so my attitude when we sold them, well, when do we sell them? Let's take a look. Let's not be, we on 2-6, this was one of our earlier trades. So on 2-6, I'm looking for stocks I like. If they got cheaper, and Sealed Air hit my radar, and I said, you know what? If Sealed Air gets cheap again, I like Sealed Air. My stepfather used to work doing pack E. He made ink products for Sealed Air, not specifically, but he sold polymers and things to them to make inks to do on their packaging. So and they're in New Jersey, so I happen to have gone to their business on a regular basis. It's a good business, and I also think that they're the air bubbles packets. That's what Sealed Air does. Air bubble wrap as opposed to foam. And it seemed to me that all this environmental bullshit concerns that's going on is going to cause a trend towards more of their stuff going back to them. They over the years lost money due to the trend going the other way, more to like peanuts, but those peanuts are gone, and people have to go back to this or the cardboardy stuff. Anyway, so I like them long term. And I said, well, maybe they could fall, but they're probably going to fall here. I'm surprised. I think that's maybe why we didn't pull the trigger. I'm surprised they fell to 30. That was very surprising. It was way overdone, but we should have bought it in there, but we didn't, so we missed it. And now they're kind of interesting, but now that they went to 30, I really kind of would like to see them test out around 34, 30, come back about halfway, and I'll be interested again. And if we look at Sealed Air, oh man, I don't have my. So annoyed. What is that thing called? Stockopedia. Stockopedia. Okay. So if we look at their money, what is this? What's going on? Why am I not logged in? Oh, because that's not Sealed Air. Some English company. I didn't pay for the English version. I paid for this version. I love these guys. They really get down. Look at this. So as you can see, they really got killed by trends in the industry, but they stabilized. Earnings are stabilized, and they're coming back to better numbers. I don't know if this was an aberration. I'm not sure what that was, but they're coming back to normal earnings, which is $400 million. And meanwhile, you can buy the entire company for $5 billion. So they're let's say $6 billion. So they're trading about 15 times earnings, but I think that they can do better. I think earnings are in a turnaround mode, and they should start having some positive trends. So they're a good, steady company. And again, like I said, I didn't want to buy them for that price, but I said, if they go on sale, then I'm kind of interested. I'm still only kind of interested. So we haven't pulled the trigger on getting on there. But if they come back down here and we another 10% down, and now instead of 15 times earnings, I'm paying 12.5 times earnings or something like that, then I'm kind of interested. All right, then I like them enough to add a spread to them. But that's how it works, okay? We get into a position, we start off with a position, and then we add to it. You see a lot of these in the actual stocks. You'll see, look, see Celgene? Wait, not Cell, no, CDE. See CDE on 1/9, we sold 30 puts. On 9/24, we have a spread. Cheesecake Factory on, oh, that's a bad example. Wait, what is this? Okay, I guess that was an older position. Sorry. Here you go. Here's BHC, which is really VRX, the old VRX. On 3/2, we sold some puts. On 11/21, we have a full spread. Now, maybe we adjusted it. But the point is, that's how most of these positions are, is they start out where we start out with a short put, and then if something happens, we add to it. We don't, there's certain positions that we just go right away and go pick up the whole spread because we think it's super cheap, or it's a stock that we're not worried about dying. But Sealed Air, I couldn't tell you for sure they're not going to go lower, so I'm not going to play it that way. Most of the stocks in here that we sell puts, we're just testing the water to see how it goes. I'm not going to cry if I have to close it out and take a loss, but it's we're just testing. And like I said, if it turns out that they just go up and they never come back down and they never get cheaper, so we collect $100,000 and we walk away and we buy the next batch of stocks. We sell the next round of puts. That's all it is. Now, generally, I don't want to have more than 24, which is just over $100,000. So we before I start buying new ones, I like to try to retire some of the older ones. But the exception would be that there are going to be certain ones that I'm not in the least bit worried about. Like I would say Broadcom here, they're at 260 and 180 is our put. I'm not going to give this guy $3,000 to close out this put. Or maybe I did. Let's see what I said. All right, let's see what I said about OPCO. I don't think these letters are too big now. Did I even say anything? Oh, I'm sorry. I probably made a general comment on the puts. All the puts are being kept except FNSR. So why did we not keep FNSR? They're $4 up, so they're 20% above the put strike price. We have 74% of the money in, and we have to wait another year to collect the rest of the money. All right, so do I want to wait a year to collect 26% when I could sell something else for 100%? No, that's stupid, right? Also, if you look at FNSR, the chart, they have given us trouble in the past. So I don't want any troublemakers, FNSR. So I don't need this kind of agita. I don't need to worry about them going up and down like crazy. When they were down here, I was very confident. I was very confident. I thought they were crazy low price here. I thought they'd go up, but now that they're up, they could come back and consolidate back down, and it's a pain in the ass. I still think it's certainly worth the price, but why should I risk anything? We were hoping they went lower so that we could buy more aggressive position, or I think we used to have a more aggressive position. We cashed it out. But you see what it is? It's that, we're very patient, and eventually the market corrects, even if it doesn't correct. But like I said, even if it doesn't correct all year long, it just goes up and up, and we only make 10%, even though the market went up 20%. That's not terrible. That's, there's an opportunity cost. You could have made more, but I'd rather not lose. Okay, it's the losses that get you, not the wins. And that's something you really have to work on. You're adjusting your attitude about trading. It's not about winning a lot, it's winning consistently. Consistency is everything. If you consistently make money, you'll end up with a huge amount of money. If sometimes you win, sometimes you lose. Even if you win big and lose medium or whatever, you still won't do as well as somebody who just wins a little every time. Winning and not losing is the greatest thing you can manage in trading. Improve your percentages. Try not to have bad years. And this system goes a long way towards trying to keep it that way. We haven't had a real loss probably since 2008. And of course it's been a good market. It's been pushed up, and the market's up 300%. So it's not like I'm going to take credit for that. But I mean, we play it's hard to say because we're up 100% for the year, but we play fairly conservatively. It's just that when the market goes down, we take advantage of it, and taking advantage of it with options means we can make 100% very easily on our money. But we wait. We don't try to make 100% when a stock is already up. I don't go here, and again, people all summer long, everybody's like, God, it's like, when is Phil going to buy something? All summer long, I was not into stuff. I cashed out my kid's account here, and August and September, I pretty much had my hands crossed and said, I'm really not into buying things here. But thank God, because our portfolio reflects that. We didn't buy stuff here. We waited and we bought stuff here again. Obviously something goes here and there, but generally no. I buy things when they're on sale. When they're not on sale, I'm happy to wait 6 months or a year for the next sale. I know it's hard because I run a subscription newsletter and people say, well, what am I subscribing for if you're not buying anything? But I think the service is more to help people time the markets better and learn when to trade and whatever. And if it's not a good time to trade, I don't have control over that. It just wasn't a good time to buy, so I didn't want to buy. Now it's a good time to buy. Now there's things on sale. Now there's lots of things that are worth buying. A lot of things have gotten too cheap, and are still too cheap. And that's why our activity is spiking up again. We're back into that mode. All right, let's see who's got questions. Nobody. Oh, FNSR is being bought out. That's right. Silly me. So why did I do that? I forgot. I guess I forgot they were being bought out. You're right. So there's no reason for us to sell those puts. There's no reason for us to buy back those puts. That's funny. Okay, that was my bad. Oh, well. Oh, no, I'm sorry. I take that back. I did know that. I know they're getting bought out to 23, but we're only going to make 24% more. And if anything goes wrong with the deal, they'll plunge. That was my logic. I did know that. I remember. I looked at that. I decided it wasn't worth it. Not only that though, but I was gung ho to try to get something off the table. It's ridiculous. It's like, how can you like every single position? It's embarrassing. You gotta at least pretend not to like something. Right? Otherwise, what am I doing here? If I say I love it, if I just have an I love it stamp on everything. These are our dividend stocks. We have more down in the main portfolio. There's a few dividend stocks. Here you go. Got Ford and Frontier. Well, the Frontier is no longer a dividend payer actually. So we got Ford, and we have Annaly, and we have NYCB. That's it. So we actually have like 8 dividend paying stocks. The thing is, if you don't have for this power options program, if you don't evenly have the puts and calls sold against a position, it classifies it down here. But if you do it the other way, it calls it a custom spread, and it puts it up here. So I actually prefer it. I like it when it's in its own section, but not enough to where I would sell puts for no reason. But the reason would be to keep it in this section. Anyway, so all these guys are dividend payers. With the dividend payers, all I care about is that they're not losing much money. As long as they're on track, and they're all on track. The net out, this is minus 19, so it's minus 1,000 on ARR. But we're collecting we're collecting more than that in dividends. ARR pays us I think 10 cents a month in dividends. And it's irrelevant. As long as they're in the range, they're at 21 and we bought at 22.50. As long as they're somewhere in the range, first of all, the premium is going to evaporate off of the short calls and short puts. And by the way, we sold the 20. So we actually expected them to go lower because we sold the $20 calls. And the 22.50 puts us in at 20.50. So if we get more, we're getting more at 20.50, which is below where we are. So I don't really care. And that's another very important point. You can't just look at your portfolio and go, "Ooh, that's bad." You have to understand why you went into a trade and what your intention was. I'm selling this stock for 20. I don't care that it's down 15, 30 because I collected $2,100 to sell it for lower than it is now. I never expected it to be a 22.50. I expected it to be a 20. That's why I sold calls. But meanwhile, what's really going to happen is come July, we're going to probably cash in the profit of this, which is currently a net $400 profit, and we're going to sell another set of puts and calls for another $4,000. And if we ever get lucky and it hits that spot, we'll get a $4,000 bonus. But that's not even why we're in this position. We're in this position. A $4,000 bonus, by the way, is 20% of the total position every 6 months that we're selling these things forward. We sold the July calls on November 29th. So every 6 months we have the potential to get a $4,000 bonus if we happen to hit our target, but for sure we're getting paid a 10% return from the dividends. And again, that's another discipline. It's not that, obviously we can do better. We got 100 positions that do better than that. But the point is, if you have cash sitting around, you don't want to put it in the bank and get 2%. You don't want to put it in the T-bill and get 3%, or even if it's giving you 4%, it's not enough money. But I can put it in a very safe, very well hedged dividend play that takes effectively zero. By the way, in a portfolio margin account, these kind of trades take nothing. They take no margin and very little net cash, and you end up having a tremendous, your return on cash is 30, 40, 50, let's say 40%. You can have a 40% return on the cash. So if you take 10% of your cash, put it in things that make 40%, then that's like getting 4% on all your cash, right? And that's better than you're going to do in a bank and as good as you're going to do in a T-bill. So now you're making effective use of your cash, but it's still in your portfolio and still able to make other moves with it. Instead of having all of your money in a bank sitting around just collecting the cash. And believe me, the banks don't let it sit there. When you give the bank the money, they put it to work. They're not idiots. They don't put it in another bank. You ready how dumb that would be? The dumbest thing a bank could possibly do with money is give it to a bank. That would be ridiculous. So that's not what they do with money. Yet they want you to do that. Things are funny. Anyway, Entercom, again, it's right where we want it to be. We bought it $725. It's at $725. New residential, $16. It's $16. It's right where we bought them. Tangier, we bought it $22.37. It's at 20. No, wait. I'm sorry. 20. We bought it $22.25. It's at $22.37. $16.60. That's the right place. $7.65 there. There's no change. But dividends are pouring in. That's the point. Thousands of shares collecting dividends. Down the road, and again, this is what you talk about when you're older. When I'm older, when I'm 75 years old, I don't want to probably be messing around with the market every day. I don't want to be sitting there staring at these things. So then I can just go sit back and relax. And I'm just going to have this dividend pump, constantly putting money into my account, constantly. And I can live off the dividends and leave all the money to my kids, leave all these stocks to my kids who can also live off the dividends. And then their kids will be able to live off the dividends. That's the point. So these are the kind of things you want to build for the long term. Don't poo-poo them just because they don't make the kind of returns our other plays do. This is the bread and butter of your long-term retirement. Oh, and by the way, when I talk about leaving to my kids, my kids are smart, but neither one of them's had any interest at all in my business in getting into the market. I tried with both of them. Jackie's actually quite talented at it, but Jackie's, she's pretty much talented at everything. Oh, look, I'm a proud parent. Anyway, but she can do whatever she wants, and she's done this. In fact, she made some incredibly good stock picks from the times I forced her to sit down and look at stuff, but she has no interest. To her, it's incredibly boring, and she couldn't possibly sit here and do this. But for some reason, she loves coding. I don't get that, but that's what she likes. Um, so, and by the way, Jackie doesn't want to be a coder to be a coder. She wants to be a coder because she thinks that's the easiest way to own a piece of a bunch of different companies because she can always do projects. And like I have a guy I work with my friend Gavin, and I taught him a long time ago. I'm like, don't work for money, work for stock. So he always goes in, gives them a really low price because he's got, over the years he's built up a nice portfolio. He goes in, he does projects in exchange for stock, and especially in startups, and he ends up owning a little piece of a bunch of startups. And every once in a while, one of them cashes in and pays him a ton of money. He does coding for huge amounts of startups. And that's what he does. He comes in with a really low price, says, "I'll work for you. You'll give me X%, and I'll take care of all your coding at this incredibly low price." And I'll bring, and he's got now he's got a whole thing with guys who work for him, and he sends in teams and blah blah blah. But he did it the smart way. He did it the right way because he doesn't try to get a lot of money for the program. He tries to get shares in the stock. And he obviously only picks companies that he and I think are worth doing it for. So we look over these companies and decide whether or not we think they have a good future. So Jackie, who has known Gavin her whole life, and he's like an uncle to her. That's what she thinks is a good model because Gavin lives his life on vacation. Gavin doesn't work. Gavin doesn't show up at your company. He's wherever he is. He's in Australia. He's in Germany. He's in New Zealand. He's in Asia. He's just wherever he feels like being. He just sits there and he works. He's got good discipline because he'll sit there. He'll be in a luxury hotel, like working his ass off, like coding all day long. But he loves doing that. And so Jackie thinks that's a great career path because he can retire anytime he wants to. But meanwhile, he likes coding more than he likes making money. Frankly, that's what he enjoys in life. Anyhow, so the point is though to have a portfolio for your retirement. And so since my kids ultimately will get this stuff, I want to make sure that they get things that will be there in 20 years. I want to make sure they get things that will pay them a steady dividend and that they won't have to think about. And that also they don't have to give it to some unscrupulous guy. It can go into a trust where a lawyer watches over the account, not a broker. Nobody's trading it for them. Nobody's talking them into stuff. It's just like, hey, it's like ultimately like AT&T and things like that. I want a lot of blue chips, but it's a matter of saying that they don't have to touch this portfolio. It just pays them money all the time. Good economy, bad economy, money keeps coming in. That's a nice way to live. But you've got to have a goal. If you have a goal like that, it takes you 20 years to build up the positions. When are you going to start? So here's Apple. What do we? Okay. Oh wow. Okay. So as of the last time we had adjusted Apple, we had been super duper aggressive. We had this the 120 calls. We bought back the short calls. We did this with the puts, and we have the 15 short puts here plus these other short puts. Well, these short puts. So we have 10 short puts here that are in bad shape, and then we have 15 more short puts here. So we have 25 short Apple puts that are negative 42,000 and negative 45,000. So we have $90,000 of Apple puts. And if Apple gets back to $200, we're going to have $100,000 profit on just those puts. All right, and if not, at the moment we're down. Sorry, go up and down so much. At the moment, we're down 19 plus 9, so we're down about $30,000. So we have a potential $100,000 gain against what's now a $30,000 loss. I don't mind that. And of course, it's not permanent because we can roll it. I mean, obviously, when you already have 25, rolling is painful. But let's say I just rolled the loss. Let's look at that. What if I just rolled the loss? Well, then I could cut the position in half because I'm only going to, the $30,000 loss, this is a $42,000 position right now. The 170 puts for $28, net 140, that's a $42,000 position. So I could actually roll at $30. I could roll my loss to 10. I could cut both of those short puts, roll my loss to 10 170 puts at $28, and all I've done is roll the loss. So I'm carrying the loss, but I have a chance of getting it back and having no loss on my puts after all that trouble. And then I just deal with a long position, which at the moment is up $41,000. That's all we're doing. We just, we're it's almost like playing leapfrog. You just kind of move above, or checkers like kind of moves. It's like you just skip over this and move that, and if it goes there, then we move it that way. And you always keep yourself in a position where you can make a profit. And if same as chess, don't get boxed into a corner. Don't have such a big position that you can't deal with it. Now people say, oh my God, 25 short apples times a $1.70 is 2,500 times 170, $425,000. Half the portfolio would be Apple if it went to zero, but it's not going to zero. And again, that's what I was talking about before. Risk. If you're not going to take a risk, then don't play. But the reality is that the margin requirement on this position is about $100,000. We have $1 million in the portfolio. I don't mind 10% of my margin being used on Apple short puts. I don't think Apple's going to go below $140, and that's what we're netting out to. So my worst case is that and again, if it does go lower and we end up taking a hit, we'll basically give up on one of the sets of puts, and we'll essentially ride out the other one. So the one that we give up on will be the loss. And we'll end up having to just ride out the loss, and hopefully it'll turn around. If it doesn't turn around, then we're going to roll to the 2023 140s. And since we still have a $30 sale price, we would then have a net of 110. And if that doesn't work, we go to the 2025 80s. But even if you say it, you're like, well, that's ridiculous. That's not going to happen. And it's like, of course that's not going to happen. That's why I don't mind having the position open. It would be ridiculous. And if it's that ridiculous, Apple's going to drag the NASDAQ with it. And then in the short-term portfolio, all of our hedges would kick in on SQQQ. And we'd make a huge amount of money on those. A good 100,000 would come into us from SQQQ. So, it's all about having the balance, but also within the balance, you have to look at each thing and say, okay, I'm willing to risk. I'm willing to risk being assigned Apple. If I have to liquidate my whole portfolio, it's not going to happen. If I have to liquidate the whole portfolio in order to have a massive Apple position at $120 contract, yeah, okay. I got to put all my money on Apple? Yeah. Okay, if I have to put all my money on a stock, I'll put it all on Apple. And it happens every time. It's happened every year. It happened in the crash in 2008. We always end up with big Apple positions in our portfolio. We start out small and we try to be good, but it always happens. They always have a sell-off, and we always say, frick this, we're doubling down. It's like it just never fails. In this case, we originally had the 180 or 160 short calls. No, we had the 180 short, not calls, I'm sorry, long calls. We have the 180 long calls, probably about 20 of them when we started. We rolled to the 160 short calls, and then went to then to the 140s, and I think we doubled down at 140, and then we went to the 120s. It just got too cheap to not put a big position on. How could you not? At that price, how could you not buy it? We control 4,000 shares of Apple stock. Okay, so Apple's at 157 and 4,000, well, it's not at 157 today, times 150 is 900,000. So we control $900,000 worth of Apple stock for $191,000. I believe, well, here. And so what did we do in our move here? We were super aggressive. Now it's a huge position. The 160s at 22.50, much more to gain. That's why I say this. Okay, we didn't cover. We will at some point. We're going to cover. And watch this. This is the fun part, because when we cover, how much are we going to get? So we have the 120 calls. And we can cover with the 160 calls. That would still leave us with a $40 spread. The 160 calls are $21, but these are 17. The 170 is a 17. I would rather take the chance on that. So we can sell the 170 calls for 17. Okay, and then we say 40 times 17, $68,000. So we would drop our net to 130, and then for $130,000 we have a 40 times, what did I say, 170 those were? Yeah. So we'd have a $200,000 spread. So we can make 100% if Apple closes up at that, not counting the short put money, but we can make 100% if Apple closes up at that. And that's the same thing, but honestly, yeah, it's a good point to make. It's kind of the same thing. It's the same thing we always do. It's the normal way that we start a position, move into a position. And even when we close another position, we still sort of go back to start reconstructing the same sequence. Because the way our system works is it forces you to buy when things are low, and it forces you to sell when things are high, which is what you're supposed to do. And it helps enforce a discipline that you should have in the market, which is to, when you've extracted enough value from a position, you need to let it go. You need to say, I could do better with a newer position. And we can always do better, and we always find more stuff to trade. It's not hard. And if something's kind of run its course, it's run its course. Look at this guy. Well, this one's done, I guess. This one. These are the pre expiration dates. So this one we made 100% on the short call sale there. And again, that's another nice thing, drawing this income. But don't forget, when I retire, my kids aren't going to do this. They're not going to sit there every month and evaluate what calls to sell. I have to move all this stuff into more and more dividend-paying stocks, so that nobody has to worry about what to do every month. But you know, ALK, look there. This one's up 38. That's 12, 33. But when did we buy it? We bought it at the beginning of the year. These are all from the beginning of the year. Since our original position, we never changed this one because it's been basically tracking pretty well. And what we've been doing, and along the way, we've sold various calls. So we've been making an income, and we've been making money on the trade, and our goal is $70, and it's at 64. All is well. And if we're up 30, you're not going to be up 100%. There's nothing that stops it at 100%. You have to do the math, and you have to say, okay, we've got the 45.70 spread, which is a $25 spread, so that's $25,000 in 10 contracts. That would be your best net on the spread. So 21 minus 10 is 11, so it's currently 11. There's $14,000 more to make on $11,000 net in this spread. So then I say, that's what I look at, and I say, okay, so what's my risk? Do I feel like I'm taking a big chance? Well, my short puts are net. Wow, look at that. We sold them for 8. So my short puts are net 52. And then we look at ALK. Uh-oh. I don't have those charts. So I look at ALK, and it's like, ugh, it's all over the place. It's very up and downy, but I don't think it's going to go to 52 because it's really held 58 well. And, you know, I'm not going to get into every company, but, you know, we looked at the company and we said, okay, we like, you know, it's still good. Still believe in my upper target. So there's no reason to get out of this. Just it gyrates a lot. So it's a wacky thing. There's lots of opportunities to get in and out, and we take advantage of that by selling those short calls when it's up. Every time it's up, when it's up here, we sold calls. When it's up here, we sold calls. Up here, I think we sold calls also. I don't know when the last batch was from. Yeah, 11.19. So on 11.19 we sold calls because we know what it's worth. And if it's stupidly cheap, we know what to do. If it's stupidly expensive, we know what to do. Where did it go? So on 11.19, we sold these calls for $240. We sold the $70 calls for $240. So on 11.19, somewhere around here, we sold these calls, the $70 calls, for $240. Now, initially we got burned, but if we got burned, we're just going to roll them to the next month, and we'll roll them to the next month, and we'll roll them to the next month, and roll them to the next month. All that would happen is we wouldn't make our short-term money, but on the other hand, that would be while our $14,000 additional money is coming into a full thing. So that's not a bad thing. Everyone gets hung up on like any little red spot in the portfolio, but that's not the way you got to look at it. You got to think of the whole position and what you're accomplishing, and even in terms of the whole portfolio. Sometimes you have different positions for different reasons, and I don't expect them all. You know, that's called diversification. But if you properly diversify a portfolio, not everything should go up at once. There are cycles. Sometimes some things in your portfolio will be cycling up while others cycle down. You take the money from the things that are cycling up, put it into the things that are cycling down, and in the next cycle, you'll have more money from the ones that are down going up. But it takes months and months and months, and everybody's a day trader these days. And you've got to have that long-term perspective, and you've got to ride out the waves and let it go where it goes. Do we cash out Celgene? I don't know if we did. We did probably not, because the buyout price is higher and we think it's legit. That was an incredible play. Oof. We nailed Celgene. We got in 11.19. We took around, and then on 12.13, which turned out to be like the day before they got an offer, we bumped up another play, because I was like, I like these guys too much down here. You know, they were so cheap. We only had a 60-80 spread with the 70 puts, and now they're at 85. But anyway, so definitely read the review. I'm talking extensively about that, but also go back to the last review and look at what we did there and why we did it. You know, and on Friday, we bumped up our hedges because we thought the market was a little bit shaky. Oh, did I already do that? We can flip more bullish by just buying back the short March calls. Oh, we already did that. Okay. Well, where's that? Oh, yeah. All right. Well, we did that, but then I think we actually did more than that, or we added them. But that's the short-term portfolio. So we can flip more bullish by just buying back the short March calls. So in other words, it's so easy to adjust if you're hedged, because here's our SQQ hedge, right? And we have a 200. Our main spread is 200 over here, the January 15-30 calls, and we're right at 15 now. So anything up is going to be putting more in the money for us. We had the short June 17 calls, and then we had 100 short March calls. And I said, you know what, look, we're up 60% on the short March calls. Let's buy them back, because by buying them back, now we're covered 200 to 80. And that effectively makes us way more bearish or bullish on SQQ, but bearish on the market. So it gave us a much, much better hedge. So this guy can no longer burn us, and we only would have to worry about paying this guy back, and he could easily be split, double, whatever. And we do the same kind of thing with TZA. So you can flip your whole portfolio more bearish by just simply buying back some calls that you already made a ton of money on. Same thing with TZA, right? Here's the short calls. These 2020 calls we made money on. Made 40,000 bucks. Oh wait, oh no, that's confusing. Oh wow, look at that. Oh wow. Look how much money we made on this. That's crazy. But these were leftovers. It's not like we made that bet. I mean, we actually flipped extremely bullish. We had 200 longs and 500 shorts. So we flipped extremely bullish. And we were able to do that because we had $734,000 in cash sitting in the portfolio. So we had all the margin in the world and figured may as well use it. And that's what we did. We'll see 1226. All this happened on 1226, the absolute bottom of the market. We made these moves, which led to these gains. You know, and I said this morning, I think, I don't know if I said it to you guys, but Jeff Bezos said something which to me, he said it like a month ago, and it really resonates to me like a really important point, is that a CEO, he's talking about his own job. He's like, look, a CEO is paid to make just a few very, very, very important positions each year or whatever. But that's really true. It's like you're making positions, and the same goes for somebody who's a fund manager, a hedge fund manager, or whatever, like me. You know, you're paid to make a few really tough calls and get them right. And you're not always going to get them right, but if you can mostly get them right, if you can have a good percentage, and if you manage your risk properly, over the long run, you'll come out very far ahead. And that's what you want to do for your company too. And again, that's the same thing. That's why, you know, it's why I was a good corporate consultant. It's why I was a good M&A guy, because I could look at the risk and I can analyze something and see where things are going. Sorry, distracted by somebody outside. But that's what it's all about. It's not about every day doing this and doing that and grinding things out. It's about these big moves. You know, I interrupted our trading day on the 26th to get super duper aggressive, to get super duper bullish, to reposition our hedges, because we cashed in these huge winning hedges of a couple of $100,000. That's why we have so much cash in the short-term portfolio. We cashed out our successful hedges and we flipped extremely bullish. It turned out to be exactly the day that the market turned. But it was because it wasn't for no reason that we were down. We were down because of the government shutdown, which was stupid. We were down because the volume of the market was barely open. The rest of the world wasn't open. We were the only idiots showing up on December 26th to work. And in this incredibly low volume, the futures had gone down and tanked coming in from the holiday. And it was a complete overreaction. But you've got to be able to make that call. That's the trick. If you look like it, and we could make that call because our portfolios were balanced, and we did have a big gain. And the worst thing that would have happened if I was wrong and we went down another 10% the next day is, instead of making $200,000 on our hedges, we would have probably given back $100,000. But overall, it wouldn't have had a major impact on the portfolio. And again, it's what I'm talking about with the college fund. Does it have a big impact on you or not? We have a fantastic year. We could afford to take the risk. And because we could afford to take the risk, and because it was logical to take the risk, we took the risk. The risk paid off, and now we have embarrassing amounts of money. I mean, it is really, I mean, it's embarrassing. We started off with these two portfolios. The short-term and long-term portfolio started with $100,000 in the short term and $500 in the long term. Now we have now we have 650 plus 950. So we're like 15, 16, $1.6 million. We have $1 million profit in 1 year. But and I don't want to say it's skill. It's certainly not a skill, but it's just that using the system the way we use it, if you happen to have good timing, it's incredible how much leverage that provides you. If you have good timing, we did have good timing. We are reaping the benefit. But don't expect that going forward. This was crazy. This was a perfect year for playing the market this way. As with my children's portfolio, as we go forward, if 2019 looks more uncertain, and I don't see the same kind of bullishness in the market, or we have the same kind of nonsense going on with the shutdown and everything else happening. Oh, Trump speaking in the White House, he knocked down the market. It was doing better. Pelosi to block State of the Union. Yay. He's so pissed. Pelosi's stopping him from doing State of the Union. I love it. He's so mad. He's like, I'm the president, God damn it. Anyway, so all this is idiotic, obviously. And, you have to take advantage of the idiocy when it happens. But if this is going to continue, and if we don't see something clearly obvious, we're not going to trade because I'm going to lock in. I'm going to keep my $1.5 million. Thank you. I'm not going to risk 1.5 to make 3 next year. You're going to make another 1 next year. We didn't set out to make $1 million this year. We set out to make 30 or 40%. We just happened to do way better than we thought. But that's not something you expect to happen. So, going forward, we're gonna still try to make 20 to 40% in our portfolios for the coming year. But already though, I'll tell you, the options opportunity portfolio and the money talk portfolio both are by 2021 are supposed to double. So they're both on track to make 50% a year, both of them. And that's from where they are now, the positions that we have now. If you go back to the old Money Talk portfolio, I did a big review. So every once in a while I do a big review, not in the long-term portfolio. I don't have the time in my life. The Money Talk portfolio, member chat room, January 17th. Here, that's it. If you go back to the October 24th review of the Money Talk portfolio, you see what I did here? This, I strongly recommend you look at this too. This was the day I was on the show. I was going on the show. Oh, and I'm on the show next Wednesday, by the way, on BNN. Same thing, BNN Money Talk. And it's not 7:30 to 7. Don't get that wrong in your studio time. So it's 7 o'clock Wednesday night, next Wednesday. I will be on Money Talk. And obviously we're doing this webinar before, so we'll talk about what I'm going to be talking about then. But leading up to that show, I did a full analysis, and I'll do another one probably next week. ALK, a short put we're confident in, should gain another $3,000. SQQQ, blah, blah, blah. I didn't have a number for that because I wasn't sure if it would go up or down. ABS, so I put how much I really believe that we're going to make on each position. Okay? Realistic goal, if all goes well, would be that much would be great. Now I said at 35, even though our hedge is higher, I said 35 is probably a realistic target, not 45. WPM, whatever. So all in all, these positions, which were currently $95,000, we're going to make another $70,000 between now and 2021. Now, obviously, we'll add some more positions, but that's what we planned. In fact, I added this TZA hedge, and I added the MU spread, which I don't think is doing well, and we added the MJ spread, which is doing well. And so if we go to the Money Talk portfolio now, which was 95.6. Oh, that was, I'm sorry. No, wait. Yeah, it was 95.6 at the time. And it went up to 101.7, so it gained 6%. Even in the, now, that's in the quarter. So it's still 95.5 in God knows when. That was from our live chat room the 17th. So on the 17th, it was 95.5. And then 7 days later, we had a little pop. But that's all it is. I want it to be balanced because I can't make moves in this portfolio unless I'm on TV, which is only once a quarter. So I want it to be as balanced as possible. But then if something good happens, it does tend to take advantage of it. That's how these positions are set up. So like I said, MU, well, actually, MU is not negative. It's not doing well. MJ is doing very well. WPM is doing very well. Here's MJ. LB, what was the other one we added then? TZA. And TZA is actually doing well considering, for a hedge, it's good. The cat puts are even doing good. So everything we added then added to the portfolio and made it better. And now we're going to make some major moves though to make changes, especially GE. I've not been able to take advantage of GE's drop because we haven't been able to make an adjustment since it happened. All right, so a couple of questions and I wrap this up. Do I think CMG is a top? I would not bet against them. Well, I want to take that back. We have short puts. I mean, sorry, short calls. We have short calls in CMG. I think it's interim. It's a top here. I think this is a bit high for where they are. Long term, though, they do have the potential to get back into the 6 and 7 range because at one point they were there, and the thing is they were up at 750 at one point. So this is quite a come down still for them. They're being more realistically valued now. The growth has never materialized, but if they do have the tools in their belt to grow things back to a better level and improve margins and so on and so forth. So they, again, not that they'll deserve it, but if they grow their revenues 30, 40% in the next year or so, they could go back to getting a 30, 40 times multiple. And then they'll go up for that reason, not because they should be, because they should still have a 20 multiple at most. But the combination of more earnings and getting a higher multiple can send them back to 600 plus. So you got to be real careful. As it stands in the hedge fund, we sold the 500 call short. I don't know when we did that. Probably around here we did it. We thought that was a fair price. So at some point we sold the 500 call short. It might be the second time we sold the 500 call short. And at the moment it's over. We in fact, I think we failed. I believe we failed to cash them out here because we didn't think there was any way they were going to come back, and it came back. So it's really annoying because we should have cashed them out and come back. But for whatever reason, I think just because of the holidays, we didn't get around to it. And then it went flying back so fast that we were like, oh, this is bullshit. So now we just have to roll them. So I don't think it's going to fly up. We'll see what earnings are, though. That's what we're sort of waiting for earnings to see what actually happens. But I can't imagine how the earnings are going to justify being above 500 right now. They can't possibly make that fast of a turnaround. Can you discuss the risks inherent in the NLY? The 12.2% return on dividends is compelling and tempting to overweight my position. I would never overweight into any single REIT. Overweight is a bad word. I would keep light positions in several of them, not overweight any of them. I happen to love SKT more than NLY, but NLY is fantastic. It's just a good management, and all they're doing is playing the bond market. Essentially, they're borrowing from here and lending to there and moving money around. That's what they do. It really doesn't have anything to do with the housing market or the mortgage market or anything else. And people think that like rising rates go against them, but they don't really, because they just write higher contracts. So the people who borrow from them. Yeah, and you're right. The market does view it as very risky because, look, in 2008, everything fell apart. But, to me, I look at guys who rode that out and survived and thrived, and I say, well, that's somebody I want to have my money in. It's like betting. It's like, I don't want to say the Warren Buffett, but it's like saying, okay, I'm giving my money to Warren Buffett and letting him run it, because that's what you're doing. They went up to 20. They went down to 10 almost, which is where they are now, frankly. Then they went back up to 20 and down and up and down. That's why there's risk price. Then they go up and down like a yo-yo. 100% up and down. 100% up, 50% down, 100% up, 50% down. It's almost normal in their thing. And of course, they distribute all the profits, so they're only as good as what they as the next quarter. There's nothing in the bank. They buy more properties and they increase their size and so on and so forth. But on the whole, let's go back to this guy. So, it's uneven. 2.8, 4.9, because the revenues are what they're collecting in the spreads. The profits are what they're collecting in the spreads. When they have a jump in revenue, it's all like all profit for them. You can see it here: 1.7 to 3.7, 1.5 to 3. It's all profit. It's 100% profit dropping to the bottom line when they have a nice move. But you don't count on that. You count on the normal rate of return, the normal money coming in like that. But if they're doing this, they're rock solid. I don't need them to do more. I just need them to stay where they are and pay my dividends. So, and here this year they took a loss in 2014. You know, it's going to be that kind of business. And at some point you hope not to be there the year they write a bunch of stuff down because that's inconvenient. But the whole time they paid their dividend, and if you're in it for the dividend and you don't care if it goes up or down, by selling these puts and calls all the time, and let's take a quick look at NLY. NLY. So if you buy it right now for $10.29 and you go out to 2021, you can sell. I wouldn't do that because there's not enough money. You can sell the $10 calls, but that's not worth it. But I can sell some $10 puts for $150. $147 was the last sale. So I sell these puts for $150, and now I'm in for $850 net. So then the question is, how much are they actually paying dividends? Yahoo's easy to find out. My screens I gotta look at to do one thing. So yeah, dividends $1.20. All right, so really, here's the thing. If the dividend's $1.20 and I can collect $1.50 just for promising to buy them at $8.50, that means I don't have to pay the $8.50. I don't have to hedge, right? Because I'm already getting it at $8.50. So what do I have to sell calls for? It doesn't make any sense. I don't have to buy the stock. So I can collect $1.50 for promising to buy them at $8.50. Now they're $10.29. $8.50 is a $2 discount. So I could buy 25% more than I was going to buy. So if instead of buying 20 shares, I bought 25. Instead of selling 20 contracts for 2,000 shares, I sold 25. That's fine because I'm doing it there. So I could sell 25 times whatever. So I sell more than I thought I would sell, and I'm collecting almost as much dividend by doing that, by the short put, than I would collect in dividend. So it's almost not worth buying the stock, where instead you may as well just sell some short puts for the amount you would like the stock to be, or even for the amount that you would like to own if the stock did drop $2 on you. Would you double down? Though, if you bought at $10.29 now and it went to $8.50, would you double down to average $9.50? Or more to the point, if the stock's at $10.29 and it dropped to $6.50, would you double down to average $8.50? And if the answer is yes, then that's how much money you can spend right now. And not spend, but I mean, that's how much effectively puts you can sell. So you could sell twice as many puts as you would have bought stock. And if you do that, you'll collect more money in the put money. Collecting $1.50 is why can I not do math? Is 25% more. The $1.50 is 25% more money than if you had the stock and collected the dividends, and your risk factor is mitigated because your net entry is $8.50 to start. So given the incredibly crappy price being paid for the calls, I would tend at this moment not to even bother. Okay, although if you bought the stock for $10.29 and you sold the $8 calls for, well, see, $2 is ridiculous, obviously, because that wouldn't make any sense. But if I could sell the $8 calls for $2.50, and I could sell those guys for $1.50, now I've collected $4, which makes my net $6.29, and my worst case is being assigned more at $10. So I'm still back to $8, but now you own the stock. So there's a case to be made for that as well. Oh, by the way, don't ever sell 2021 without looking at 2020, because maybe you can get almost the same. Now on the short puts, no way. So I'd much rather sell the 2021s. But look at the calls. If you sell the $8 calls, you're gonna get $2.25, $2.30 here, which would be silly because that's basically the same price as the stock. So in that case, I would ask for. If I can get $2.30 here, I would ask for like $2.60 or $2.80 here. And if you get $2.80 for the 8s, and you get $1.50 for the short tens, then buying the stock makes sense because now you got a really good, nice low net. And if you do get called away at 8, so what? You're gonna make 25. You're gonna make 33% on the stock part. And if it goes lower, you get a sign, and you end up with an $8 entry anyway. So that's how I would play that. I would like to ask the same question about AGNC. AGNC, the same thing. It's the same concept, same everything else. They're both good. I like the ones that we have. I like ARR as well. Another really good REIT. CIM. Is it CIM? Chimera. CIM is the same management as NLY. So if you can get a better price on Chimera, then go for that. And look, nope. See, they only have short. The reason we don't have CIM is this, because they don't have the longer term options. So I prefer to have at least the ability to see where my rolls are going and do comparisons. These guys have very few options months, so I don't like to play that. They used to. I swear they used to, or for whatever reason, we got into CIM once. They were super cheap, and that was a big home run for us. Oh, look, now the market's back up. How crazy. Things are all over the place. How's RTY doing? Still not good. I don't like that. I am not encouraged. Why is CIM there? How does it know? Was that there before? That's crazy. How did it? That's really random. I don't remember talking about CIM. Anyway, and it's kind of scary if it's changing itself. Oh, here's natural gas coming back. Very nice. I'm pleased. Everything's looking good. Oh, oil's up. Gasoline should be coming up. Yep. Natural gas, we have a natural bet on the not these, the NG H19s, I think. The dollar's coming back a bit, so everything's calming down from where Trump was. Silver, I said this morning, was a good play, and that's coming back. So all looks well. Anyway, so look, the bottom line is, oh, by the way, the most important thing that's happening right now is that we are. Oh no, Jean-Luc, when did you do your thing? Oh, here it is. Okay. We're back over the 50-day moving averages on the charts. These are the 50-day moving averages, the blue lines. As long as we hold those blue lines, everything is hunky-dory. We're consolidating in this zone between the blue and the red, between the 50 and 200-day moving average, consolidating to allow the 50-day moving average to form a bottom. Then when it starts coming up, that'll be a very powerful signal. This is a death cross. Then we form a base. And then when the blue starts trending up, that's great support, and you can break out above and start turning the red line up too, and then you're into another rally mode. So there's nothing bad about this because they have a very gentle slope on the 200-day moving averages, and the 50s are easy to bend. So you can bend them back very quickly by being above them. So all we're looking for here is just to hold this zone between the 50 and the 200. And as long as we're somewhere in that zone, which we probably will be, I don't see, unless I don't see any reason to be lower than the zone. And if we stay in the zone, and if earnings aren't too bad, and then if they start fixing China or fixing the government, we can at least move back to the tops of the red lines, to the 200-day moving averages. And if we fix China and the shutdown and earnings aren't so bad, boom, we can be right back over and moving back to, again, I don't think we go all the way back to where we were, but we still, have a nice recovery. So we shall see. All right. Anyway, that's all for today. I can't believe that was already 2 hours. That was incredible. I was incredible. I'm glad you enjoyed it. I hope you enjoyed it. All right, guys. Have a good day, and we'll do it again next week. All right. Thanks.